Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me today is Hormaz Patakia. Well, it's one of those days, right, where there's a lot of volatility, there's a lot of pressure that we're seeing on the benchmarks and especially on the broader markets as well. We did see a sharp fall from the highs, then there was a recovery as well. Right now, the Nifty is down 140 points, but it did fall below that 23,700 mark as well. We have the mid caps with us sitting with cuts of around 760 points. At a point in time, we saw a 1,000-point cut almost on the mid cap index. The advanced decline ratio comfortably in the favor of declines, 1:8. That's the kind of market breadth that you're looking at. And be it good results or bad results, largely we're seeing that gap widening by the minute on the mid-cap index, and very few sectoral gainers as well that we have today. I would say actually none of them. All of them are in the red today, Hormaz, be it financials, be it the banking index, Nifty Realty, Nifty Auto. Auto index has also fallen around 20% from the highs. So a lot of profit booking and, everyone's been talking about valuations as a concern and calling it a much-needed correction.
Much-needed correction, and in a very, very choppy market, isn't it? It's a blink and you miss market. You see the Nifty down 400 points at one point of time. You come back 5 minutes later and it's down 200 points. So that's the kind of market that you are in. But yes, it's been that kind of a market. 23,650 is that level to watch out for on the downside for the Nifty. That will mean a 10% correction for the index from its record highs on the 27th of September. And that would also mean that is the key support level as well that Jay Bala was also highlighting in the closing session, in the closing trade yesterday. But the small cap index is the one that I wanted to highlight though. 9%, almost down 10% now from its record highs. Mind you, the small cap index made a record high much before the Nifty did. It was on the September the 6th is when the small cap index had made a record high. And since then, it's down nearly 10%. Almost half the index is down 10%. 20 stocks are down over 20%. So nearly 3/4 of the index has already seen double-digit losses from that period. But there are some stocks that have held on to gains during this period from the 6th of September till date. And some of them that I wanted to highlight, Amber is one, Nalco, Keynes Tech, Piramal Pharma and MCX. They've seen gains of anywhere between 15 to 35% during these last 2 months when the small cap index has been in correction mode. But the common factor between all of these is all of them have had very good results during the quarter. In a quarter that has otherwise been a disappointment, most of these companies have had good results. Take a look at Amber, in 82% revenue growth, 90% EBITDA growth. Same for Nalco, revenues were down, but EBITDA was up 60%. There was a very sharp margin expansion as well for Nalco. Keynes Tech, 58% revenue growth and a 70% growth in its EBITDA. So good results have been rewarded. The stocks have held on to the gains, but there's been an equally extreme reaction on the flip side as well.
We have seen sharper falls for bad results, even for Nifty companies for that matter, right?
The Nifty company is more pronounced as well, right? Be it Bajaj, Maruti. So all of them have seen a very, very sharp correction. There's been an extreme reaction to most of the results, be it good or be it bad. But corporate conversations, and we'll be the ones heading to the primary markets first. It's a day of listings. It's a day of IPO announcements as well. And the 1,115 crore rupee IPO of Zinka Logistics has opened today for subscription, with the price band being set at 259 to 273 rupees a share. It's a fresh issue of 550 crores and OFS of 565 crores as well. Now, to discuss their growth plans going ahead, we are now being joined by the company's CFO, Satyakam Nayak, to discuss the road ahead for the company. Satyakam, good morning. Thank you so much for joining in. And firstly, congratulations on the IPO. Basic question first up, could you please explain to our viewers your business model and how exactly do you as a company make money?
Sure. So think about trucking, you think about Black Buck. So the truck operator in the country, if you look at it, he is typically middle-aged, generally not so digitally savvy, works in the hinterlands, largely inefficient. I think where Black Buck comes in is to empower this truck operator to grow his business, to manage his business, make his business more efficient. So this is where Black Buck comes in. There are 4 areas in which we help him. One is on payments, where we help him with tolling, fueling. Second is telematics. It's all about gaining control over his vehicle and his driver through GPS, vehicle tracking, fuel sensor, etc. Further, you know that broadly 15 to 20 days in a month, he keeps looking for loads, right? So we have a loads marketplace where he can get loads from anywhere in the country. And vehicle financing, large part of used vehicle financing today is still informal. So we are trying to organize that by working on generating loans for our partner banks and NBFCs. This is broadly the gamut of services that we provide, focused on the Indian truck operator.
Okay. So Satyakam, so basically the truck operators are your main customers, so to say. You said you help them in 4 ways. So can you give us a sense of what your take rates are across your services, be it fueling, tolling, and the other segments as well that you spoke about?
Sure. So each of these service lines have different revenue streams. The revenue streams for each of these services are in the form of subscription revenues, and in the form of service fees, and in the form of commission rates from partners. So this is the way we earn revenue across all these 4 sectors.
Okay. And how do you split the proportion? How much comes from financing? How much comes from tolling, fueling maybe?
The core of the business today, because of the tenuity, is the payments and telematics business. These are the businesses which are growing, which are a kind of entrance to the market. There are strong growth businesses. The strong growth businesses are the loads marketplace and the vehicle financing business.
Right. Satyakam, I wanted to ask you that despite a higher contribution margin that the company has and a large market share that you have in the industry, you guys are still loss-making on an EBITDA front, and operating cash flow is also negative. Your profitability that also came in the first quarter was also aided by an exceptional gain. What would you attribute that to? And not asking you for a specific number, but do you have a timeline as to when do you turn profitable, A, on an EBITDA level as well as on a profit level?
Yeah. So if two things. One, in Q1 25, which is this quarter, we have turned profitable at a PAT level. Even if you exclude the exceptional item of 25 crores, there's a 3 crore PAT. But more importantly, if you look at adjusted EBITDA, which is a metric, which is an important metric for us, because below that there's just ESOP cost and depreciation. That adjusted EBITDA has kind of turned a corner almost 8 quarters back. And it is continuously kind of accelerating. So that's a good kind of trend line to measure. And obviously, because the acquisitions have gone up strongly over the last 2 to 3 years, and our business is one where we acquire customers and they stay for life, and they continue to add lifetime value to they continue to accrue lifetime value. Hence, because of those acquisitions, there were losses. But as we move forward, the revenues is strongly compounding, and that's translating into EBITDA as well.
Okay, so let's get in Rajesh Yabaji as well. He's the CMD and CEO of the company. Rajesh, in that case, what do you intend to do with the money raised? You spoke about how at an adjusted EBITDA level you're positive, but if you look at the bottom line, it continues to be a net loss, right? So will you be able to turn EBITDA positive and net profit with the money that you've raised?
Yeah, I mean, just iterating what Satyakam just said, the company has, even without the exceptional item, has made profit in the first quarter at a PAT level. And, the trajectory is already there, point number one. Point number two, because of the nature of the business, where, most of the revenue comes from technology fee income, which is subscription in nature and recurring in nature. You can see that in FY24 itself, our free cash flows were positive. We made about close to 45 crores of free cash flows, and our adjusted EBITDA broadly will start, broadly mimics the free cash flow in the quarter as well. And that's something which you can already infer from the RHP, right? The money we've raised, is towards largely continuing to doubling down on user acquisition, which is sales and marketing costs, which we incur year on year. And broadly, they will be in the similar ranges to expect as we move forward in the future as well. And the second biggest area is that for the truck operators, we continue to innovate and continue to invest money in product development and research. So to the technology platform which we are building, the new offerings which we are creating, that's the second biggest area where the money will go into. And then the third area, which is the smaller area, is the financing arm of the company, where largely financing we do a more platform fee and a technology fee business, but largely for new product development and new partner development, we've earmarked some amount of funds for the life cycle of the company for the NBFC. I think that's the broad usage of funds. But chiming in again, last year we were free cash flow positive. We made close to about 45 crores of free cash flows. This broadly our adjusted EBITDA mimics also the cash flows which we as a company generate. So, and also, the money raised will cement the company's position, as a market leader in the times to come.
Okay, just a follow up on that. So how many paying, or I would say transacting truck operators do you have right now on your app? What are the downloads like? And all the money that you raise will be used for marketing and for the technology purposes that you just spoke about?
Yes. So majority of the money is going to be used for those purposes. As you rightly said, I think more than about close to 70 to 80% will be used for those purposes. Point number one. Point number two, as a company, Satya would have introduced, we are India's largest digital platform for truck operators. As a country, we have got about 35 lakh truck operators in the market who own about 1.25 crore trucks. Out of these 35 lakh truck operators in India, as a company, last financial year, close to 10 lakh truck operators transacted with BlackBuck in any one of the services which we provided. And this number is very strong. This number over the last 2 years has doubled, and continues to grow, right? And each of these services are at varied degrees of penetration. The entire game plan of the company has always been that how do we penetrate deep into every village, every trucking specific and trucking relevant village in the country, get the truck operators, trust us, trust technology, trust methods of going, the online methods to do business. And once, they become our customers, it becomes sort of a gateway towards distributing and, selling more products. So our first foray was into payments, which took as a company 3 years for us to achieve 1 lakh users. Then we launched telematics. As a company, we took about 22 months to get to 1 lakh users. When we launched our loads product, it took close to about 9 months. So basically, our ability to distribute products has gotten better and better. And as a result of the investments in sales and distribution and servicing, which we have conducted over the past 3-4 years, as a company, this is how we've sort of continued to grow. As I mentioned, strategy A is to go and be with every truck operator with any one of the service and continue to distribute and sell new services incrementally over the life cycle of the customer.
Right.
Okay.
All right, Satyakam and Rajesh, thank you so much for sparing time and joining us. Wish you good luck for your IPO and looking forward to conversing with you on your listing as well. That was the management of Zinka Logistics. The IPO opened for subscription. Time for a short break. Get you more on the markets on the other side. We'll be joined by Vishal Goyal, the head of research of UBS Securities, and Tanvi Gupta Jain, the chief India economist at UBS Securities, to discuss India's macro picture and the global economy as well. Stay tuned. Welcome back onto our coverage of the UBS conference as well. We are now being joined by Vishal Goyal, the head of research, and Tanvi Gupta Jain, the chief India economist at UBS Securities. Vishal, Tanvi, good morning. Thank you so much for joining in. I'd like to start off with asking you, Vishal, the market correction that we are in currently. The broader markets and the Nifty currently are almost down a similar quantum from their respective peaks, right? Around 10% each. But when the large cap index corrects to that an extent, you would assume that the mid cap index would, or broader markets would see a much sharper fall. For a better part of the last month, the mid cap index were fairly resilient, and only now they are facing that selling pressure. What would you attribute that to? One, and do you see a much sharper correction in the broader markets now so that it can play a catch up with the fall that you've seen in the benchmark index?
Hi, Omar. I think that expertise is anyways with Sunil Tirumalai, who is our India strategist. But I think I'll share my views here. I guess, Sunil has been highlighting that Indian market is expensive, especially in the context of emerging markets. And as we see things, at global geopolitical stage, plus global volatility has increased, I think that also brings again focus back on valuations for India. In terms of key sectors, if you look at, there are sectors who are, at life high or 5-year high valuations, and there are sectors which are trading below averages. And so to that extent, I think that dispersion in performance, I think would continue. We would see some catch up in sectors where the valuations are more reasonable compared to segments where valuations are rich, and we are seeing some earnings disappointments coming through.
Okay, all right. So the earnings disappointment is something that the street doesn't seem to like. Let's get in Tanvi in the conversation as well. Tanvi, you know, the big data that we got yesterday, the CPI figure above that 6% mark. Was it something which was penciled in by the street already? What surprised you this time? And what does it mean for the RBI action going forward? Because that's everything that somebody wants to know now.
Absolutely. So if you look at the CPI inflation, number was 6.2. We were expecting 5.9. So definitely even higher than our consensus expectation. But if I look at the data, I realize bulk of it was only on account of higher vegetable prices and gold. If you look at the cyclical food price component, it almost accounts for the bulk of the increase in CPI headline inflation, which is more transitory in nature. So I would expect the vegetable prices to start softening from the month of November. But very interesting, I tried to look at the retail data for the month of November for key vegetable crops, at least what is available in terms of retail prices. While I could see a very sharp correction in the prices of tomatoes, which is almost down 25% month to date, I could see that the prices of onions and potatoes are still elevated. So what we are seeing this time around is a much higher trend in vegetable prices. I mean, last 10 years, month-on-month momentum in the month of October used to be 4%. This time it is more than 8%. But I would say this is mostly transitory in nature. If I look at how my forecast for CPI inflation will pan out, because that will have implications on RBI's policy outlook, we are estimating CPI inflation to soften towards 4.5% and 5% in the rest of FY25. From a rate cut expectation, I think RBI is facing a very challenging task. We are seeing growth softening concerns, even though RBI is still maintaining 7.2% real GDP growth forecast as of its last policy. Inflation risks have come up, but that looks like more cyclical in nature. At the same time, the currency has weakened because of a stronger USD. So I would say net-net, we are still retaining our baseline forecast that there are 75 basis point rate cut expectation likely from early 2025. I think the timing will be a lot more data dependent, and we definitely have to see that inflation momentum is more towards 4.5% going forward.
Would it be fair to assume, Tanvi, that a February rate cut is off the table?
I would say a December rate cut is clearly off the table. I would not really say that Feb rate cut is off the table because cyclical component, you know, as I was mentioning, they go up very fast, they actually come down also equally fast. So I would hope that the fresh crop arrival, once it starts hitting the market from the last week of November, should start cool off the prices from the month of December onwards more meaningfully, which may not be visible so much in the month of November. So I will still have a higher probability of a rate cut cycle to start from Feb, but let's wait. We'll watch out for more data.
Okay, all right. So Vishal, coming on this, what does it mean for the banking space? Of course, December rate cut is ruled out. We'll have to see how RBI goes ahead with any rate cuts, only basis data that we have been getting, the macro data. How are you looking at the entire banking space, quarter two? What stood out for you in terms of numbers?
Sure. I think, see, on banking, we've been having a neutral kind of a view, partly because of the growth slowdown. This was largely driven by unsecured lending slowing down, plus also the constraint on deposit growth. The deposit growth has not been great, and banks trying to bring down LDR was also bringing down overall loan growth. That was on the growth side. In terms of outlook for margins, the longer RBI takes to cut rates, I think it is good from a margin point of view in the very near term. So maybe we don't need to cut margins as much because if the rate cuts get delayed, banks don't necessarily pass through their EBLR rate cuts. But I think the third pillar, which is asset quality, and that's where I think again we've been highlighting the pressure point building up since last 1 year. There are views on asset quality that things could be peaking here, which we don't agree with. We think the retail NPL cycle, especially the unsecured one, it has just begun. We would see credit costs going up even from here. And to that extent, I think consensus will have to cut earnings for banks in general, and especially for weaker banks and NBFC segment.
So what about the overall earnings picture, Vishal? Because the quarter, if you can stick your neck out and say, was rather disappointing compared to estimates. Even the first quarter was equally muted. What does that do to the second half and the full year estimates as well when it comes to earnings and as a result the market? Because a bigger factor for the market correction has also been these disappointing earnings.
Yeah, that's true. That's true. So I think that has triggered, some of this rich valuation to come off. And I'm not talking about banking. I think in banks, while the valuations have been reasonable, it's just that the top line growth has been decelerating. Plus the asset quality pressure started building up, which kind of capped the re-rating which you could have seen in the banking sector overall. And when we think about earnings cut, you're right. I think for financials, I can see that banks will not re-rate from here, and therefore we should stick to banks who have higher compounding, higher ROEs. NBFCs, where the risks of unsecured credit is high, we would avoid those because we would see a de-rating, especially driven by more earnings cut in that segment.
Oh, okay. All right, take that point, Vishal and Tanvi. Thank you so much for joining in today and giving us your insights, especially after that big CPI number and what's happening in the markets recently as well. Good to get your expertise on the fundamentals of the markets as well. Well, it's time for a short break. On the other side, we'll be joined by the management of BLS International to discuss the company's performance in the quarter gone by. Stay tuned. Okay, the markets are near the day's low again, testing that 23,700 mark. Some more pressure on the mid-cap index is what we are seeing right now. It's a 1,000-point cut on the mid-caps right now. When we started the show, it was down around 700, 800 points. So watch out for that one. As the advanced decline ratio, it's getting more tilted towards declines as we speak. But let's get another corporate conversation going. Tata Communications is on our radar now. The company aims to achieve margins of 23 to 25% by FY27, says Lakshmi Narayanan, the MD, and A.S. Lakshmi Narayanan, the MD and CEO of the company, in a chat with our colleague Reema Tendulkar. Listen into the company's growth plans, targets for digital business and more.
There are many aspects when we put out our aspiration. I said who we were and who we are now and what we want to become. There is a marked difference in what I smell and sense internally in the company, and also what I see and feel when the customers talk to us. We definitely believe our relevance to our customers has greatly improved. I'm able to have a very meaningful conversation, not just with the CIO, but even the CEO, to say that with our digital fabric, we're not only helping you to uncomplicate, but they're also seeing the possibility of being able to innovate with our digital fabric, right? So our relevance has increased significantly with those customers. That to me is the biggest marker and biggest mark of success, and then everything else will follow. And with that ambition, we said that, hey, we are more relevant. We want to become even more relevant in the digital world, and therefore we should set a target to say that we're going to double our revenues. So it is an aspirational target. It is an aggressive target. We are, moving towards a target.
What would be the annualized data revenue today?
We are close
20,000?
Close to 20,000.
Okay.
Yeah.
And you want to hit 28,000?
We want to hit 28,000.
It's aggressive, according to you?
It is aggressive. But hey, that's what we love about this, to say, can we hit the target? Because we, and I certainly believe, this company has the potential and the capabilities to be able to go after aggressive targets.
Even your margin aspiration, 23 to 25%. You're currently at 20%. You've said you will achieve it over the medium term. Here you've not put a concrete timeline. Would you like to do that? And why you're not saying it's achievable, say, when you hit data revenues of 28,000?
Yeah, I think that's a marker we have talked about it. By 27, we want to be in the ranges that we talked about.
23 to
25%. And hit the ROCE of upwards of 27%. I think we went through the phases of shoring up our balance sheet, getting our basics right for the company. And once we had that, we went into an investment mode. Investment mode that was both organic. We hired a lot to build a software layer. It wouldn't be possible without the investments. We did that. We also did some inorganic investment that we brought those capabilities. So we went on to investment mode in 2024, in FY24. And that investment, we were deliberately calling out. As a result of that investment, you will see a dip in all these matrices. But we said that our trajectory is in such a way that we want to hit that numbers. We will get to the 23 to 25%. There are multiple levers that we have to play with. And one other important factor in this is, our revenues are the data revenues. If you see, one is all the core connectivity, which has got high capex, high margins. Right, which is all connecting to the data centers, which is the big pipes that we do. That's high capex and high EBITDA as well. And that was a very major part of our revenues. As part of these aspirations, we said that our digital revenues need to be 50%. We are close to that. When we are at 28,000 crores, we'll be closer to 60%. Right? Now, our digital portfolio is today not EBITDA positive. In the whole, we have all these 4 fabrics. Some of the fabrics are positive, some of the fabrics aren't, because they are also into the investment mode. So look at any of these fabrics. Our whole cloud and security fabric is, would be about 150 odd million. Our next generation connectivity would be closer to 100. So all of them are at sort of 100 million ARR, barring the interaction fabric with Kalera, which we acquired. That will be upwards of 400 million ARR. So none of these in the digital portfolio are EBITDA positive today, which has got the effect of these are growing faster than the core connectivity. So you can see the mix playing the effect of dragging. But all of these have got what we call as a glide path.
So what's the glide path for consolidated margins for the digital portfolio when you hit 60% of your overall revenues by FY27?
We haven't called out the split. We are calling out in the aggregate, we will be at 23 to 25%, right? So
today it's negative, as you said.
Today it's negative. So we need to, so we will get to the positive territory. And
by?
We'll get to the positive territory in a year's time.
So where do you think digital margins will be by FY27?
We are working through those numbers. There are many moving parts, but I want to first get it to a decent single-digit number. Then we will be in a very healthy space.
So when digital margins get to single digits, healthy single digits, you will achieve consolidated margins of 23-25%.
Yeah.
That's the math behind it.
That's the math behind it.
What about more M&A? Switch is done, Kalera is done. Kalera is doing well, $400 million of an ARR, as you pointed out. Are you looking at big ticket M&As, a third one?
So we have a team that we are constantly looking at the opportunities. Most of the company's focus is organically build and organically grow. But there are opportunities that we would be actively looking for. And we have the appetite to do that now that, as you say, we have done 2. We still have the process of turning them around. We are very confident of turning them around. But we would be scouting for more.
But your leverage went up after these 2 acquisitions to 2.2, 2.3. So does the balance sheet support a big, your appetite may be there, but does the balance sheet support a big M&A?
So, I'm not saying all of that needs to happen right away. There are different funding options available for us.
Like? You spoke about the Chennai land sale.
Yes.
So that should conclude by this year.
Yes, it will. And I think we announced it as well. It's in the public, right? So we already announced that that sale is on the cards. So there is land banks. There are other subsidiaries that we have. And there are options.
Can you elaborate a little bit more about the land bank, the total value as things stand today, and even the subsidiaries?
No, I think the land banks I've mentioned before. I think there are, we carry a certain book value. We believe the market value is much, much greater. But
What's
we have
the
number? It actually depends, because a certain land, its value will tremendously go up if the type of usage that it can be put to is different. And we are at the moment somewhat constrained by the usage based on the title and the purpose for which we bought it, right? So all of that we need to work through. And once we work through that, we can get the right value. And we are a a company which is invested in a data center business with a joint venture partnership with STT. We have a 26% stake there, and that's a growing business. Indian market is today very hot with data centers. So there are options, and of course we can of course go and raise fund from the market, not necessarily monetizing these assets, but we can raise. So if there is a right opportunity, all I'm saying is if you find the right opportunity, I don't think funding is necessarily the constraint.
Isn't M&A critical to you achieving your FY27 goals?
That's not the way I look at it. No, that's not the way.
So it's not critical?
It's not. No, it's not critical. So my goal is not by hook or crook hit the numbers, right? That's not the purpose. We have
capability.
We have to build the capability to set the company in a very solid foundation for a sustainable growth in the long term.
Welcome back, and the Nifty continues to remain around that 23,700 mark near the lowest point of the day. But pull up some earnings reactions first up. Sula Vineyards is one of them. It's down 6%, but the bigger takeaway from that is the fact that the stock is down 45% from the record high of 699 that the stock had made. It's now down to 390, very, very close to its IPO price now of 357. We keep an eye out on Sula Vineyards. Also pull up Garden Reach. That stock is down 5%. One of the final companies to report results today. And we'll also conclude the shipbuilding results for the quarter, and also pull up stocks like Piramal Pharma, that is one that is holding out to gains in an otherwise weak market, and Suzlon, of course, is down 6% and has corrected significantly from its record highs of 86. But the bigger news of the day is the listing of Swiggy that happened at a 5% premium. It was a very volatile listing. It almost gave up those gains and also gained almost 10% at one point of time. Mangalam is here to get us those details. Mangalam.
Well, Swiggy, irrespective of the early volatility, it will go down as a good listing. Why do I say that? Because one, most on the street were anticipating a tepid listing. So to that extent, just a positive listing itself was good enough for the stock to, incite some fear of missing out among a lot of people. And that plate on the screen is a teller of that. 0.41% subscribed, or 0.41 times subscribed by the HNIs. Retail just about, managed to subscribe to their issue. It was an issue which was led by the qualified institutional buyers itself, and as a result of which it just managed about 3.5 times total subscription. So one would call it, in this age, a tepid subscription to that. And given the weakness in the market, there was expectation that it will open lower, but no, instead it has opened higher. Why is that? Well, because as a business, you know that Swiggy and Zomato are comparable on a lot of parameters. Swiggy is much lower than Zomato as well. That was understood by the street. So to that extent, the only question then was, at what discount to Zomato does Swiggy settle in? At the issue price of 390 rupees, it was offered at a 60% discount, and thereafter, now currently, the stock is trading at around a 55% discount to Zomato. Going forward, what will be interesting is to see whether the company goes ahead and lives up to the commentary that the management had promised during the IPO itself, which is that of opening 1,500 dark stores over the next 4 to 6 quarters, that leading to growth in their quick commerce business. And the second one is the food delivery EBITDA margins, which currently are just shy of 1%. The industry can perhaps sustain at around 5%. By when does the company get there? So those factors are things that we'll be watching out for. As of now, the stock was offered at a much larger discount to Zomato than what the street was anticipating, and currently it is narrowing that gap with Zomato when it comes to valuation. This morning, interestingly, we had a report coming in from Macquarie as well. They have an underperform rating on both Zomato as well as Swiggy, but as per their own calculations and target price as well, they valued Swiggy at a 37% discount to Zomato, which it currently trades at around 40-45%.
Okay, 14% higher on Swiggy as we speak. Thank you so much, Mangalam, for joining in with all those important details. Let's move forward. I'm looking at Reliance Industries because there is an interesting report which is coming from CLSA where they title the report as Buy Right and Sit Tight. Remember, Reliance Industries has seen a sharp fall from the highs, and now they say it is a good time to look at the stock. There is, of course, excitement that we've seen in the recent past for a lot of these Indian solar PV manufacturers, and they say that even Reliance Industries has that big opportunity which the street is not factoring in right now, because they will be launching that solar PV giga factory. They value Reliance's solar business as $30 billion, the overall new energy business, which has other things as well, green hydrogen, electrolyzers. Totaling all of that, it's around $43 billion. And this is something which is not considered in their target price right now. They say it assumes a nil value for new energy. It is a conservative valuation that they're looking at right now. But they say this is an attractive opportunity to play triggers through 2025 after 3 to 4 months of lull that we've seen in the business. So what would those triggers be? The first one would be retail recovery. Retail will continue to see slower growth, but there will be a recovery in 2025. Ramp up of air fiber subscribers, and a potential listing of the Geo business. That is something that the investors could play on with Reliance Industries stock. This is something which is likely in 2025. They maintain an outperform rating with a target price of 1650. They say the 1650 doesn't have the new energy valuation, so there is more upside that they're expecting here.
Music to the bulls of all the Reliance Industries bulls, right? The stock is down 20% from its peak of around 1600 rupees that the stock had seen, and a key contributor as well to the market correction that we've seen. Time for a short break. Then the management of BLS International on the other side. Welcome back. In conversation now with the management of BLS International that reported a very sharp expansion in margins for the second quarter. Revenue growth has been flattish though on a quarter-on-quarter basis, both in visa services and the digital services business. To discuss more on the quarter gone by and the road ahead, we are being joined by Shikhar Agarwal, who is the Joint Managing Director at BLS International. Shikhar, good morning. Thank you so much for joining in. I wanted to start off by asking you about the visa revenue growth, which was around 30% on a year-on-year basis, and this despite volume growth and net revenue per application being in excess of 40%. So what kept the revenue growth in check during the quarter, and what's the picture that you're seeing for the second half of the year?
No, if you see overall the revenue, on the quarter has grown 21% compared to last quarter, last year. And the visa revenue has already grown more than that. The volume, of growth of visa applications has been 40%. And we've also seen revenue growth in that. Quarter two normally is a little subdued. Quarter one and quarter four is the highest in terms of revenue for us. But still, if you see on a year-on-year basis, we have done a 21% hike in revenue and around a 90% hike in EBITDA. And the margins have also expanded to 33%. So we feel that we can maintain these margin levels now.
So you will be able to maintain margins at these levels of 33%, and revenue growth, what does it look like in the next half? Will you be able to do 20% or better than that?
See, definitely, if you see in the last 5 years, we've done more than 70% of CAGR growth. And this quarter also, if you compare the EBITDA levels and PAT level, we have grown more than 70-80%. Revenue has grown by 21%. I think we expect to maintain that levels. Also, we have done a couple of acquisitions, as you know. The merger of iData has already happened in this quarter. We have seen 60 crores of revenue of iData come in. That too only on not full quarter working, because we acquired the company on 10th of July. So those revenues will fully come in the next quarter. Also, the company Citizenship Invest that we completed the acquisition in October. So those revenues should also come in. So definitely we will see good revenue growth both from organic and these inorganic opportunities that we have done.
Excluding iData, what would be the visa revenue growth, Shikhar, for the quarter? And part two of my question is, you've moved from that transition from the partner-run centers to the self-managed ones that you guys have done. Now, how many of them do you have currently? How many of them are partner-run? What's the mix here? Or have you moved completely to the self-run base?
See, the volume growth from the organic business was 18%. So overall, we had a 40% increase in visa volumes. This quarter, we did 10.1 lakh of visa volumes compared to around 7 point something lakh in the last year. from iData, 1.6 lakh volume was added. So 8.5 lakh we did organically. So there was a 18% growth in terms of organic volume. Also, we have majority of our centers are fully owned and operated by us. So I would say more than 70-80% are being operated by us. There are still certain geographies across the world where we are evaluating that, where we could shift, where the law of the land allows to shift to 100% owned entity. We are evaluating that. So that could also take place in the near future. But the margins, I think we grew from 21% to 27% and now 33%. So we first want to maintain and consolidate at this level. So we want to first maintain this levels of margin.
Okay, all right. This is about the visa business and how that is shaping up. But the digital business, that has been struggling in terms of revenue growth. The revenues are down 1% sequentially. It's down 6% on a YY basis. What's happening here? What's the outlook?
See, even in the digital business, we have actually seen organic growth. One of the contracts that got completed last year, we did not renew that contract. So revenue from that contract did not come in this quarter. In spite of that, if you see, our other businesses have made up for that. So we have actually seen growth in our banking correspondent and our e-governance business in different parts of India. So we definitely see a good future in our digital business. We've also announced some acquisition of a company called Ardifilis, which is a loan distribution company that the transaction should get completed within this month. So that will also add to the revenue and profitability of the company. But we are bidding for multiple tenders in e-governance, and our reach with business correspondence has also increased to more than 30,000 BC centers with more than 1 lakh touch points across India. So this company is fairly new, 5-year-old company, but we see good growth coming in the coming quarters and coming years, and even in digital business.
Right. What's the cash on the books currently, Shikhar? And you said that you have recently announced an acquisition. Is there more in the pipeline?
So currently, as of September, 6 months ended, we have around 900 crores of cash on the books. That is post iData payout that we've already done. So as you know, we are a negative working capital cash generating company. And this another acquisition of Ardifilis Loan Solutions, definitely that cash still needs to be paid out. So once that is done, we first want to consolidate all our acquisitions. We've already started, combining some centers with iData across geographies. Our costs have started to come down. Margins in those countries have started to go up. So we first want to consolidate, and then definitely, we are looking, as we grow as a company, we are constantly looking how to best utilize the cash on the books. Since we are a negative working capital company, we have a good dividend policy, and we are also looking at more inorganic opportunities that can, value add to our existing business.
All right, so we'll watch out for those opportunities that you lap onto, Shikhar, and have a conversation later. But thank you so much for joining in today and talking about Q2 numbers and the way forward. That's the word coming in from BLS International, looking at EBITDA margins of 33% and will be able to maintain that growth level of 21 to 22%. With that, we'll slip into a short break. When we come back, we'll talk about markets and a lot more. Stay tuned.
Back with us here on Trading Hour. The Nifty continues to remain near the lowest point of the day. The broader markets, though, the mid-cap index is back with losses of around 1,000 points as we speak. Bharti Hexacom is one of the stocks that is bucking the trend. One of the few gainers on the mid-cap index, is up around 4% at the highest point of the day, as is Piramal Pharma, is building on to gains now, trading with gains of almost 7%. The top gainer on the small-cap index is Piramal Pharma, and also pull up Manappuram Finance. That stock is one of the few gainers in today's trading session, trading with gains of close to 3%. But mind you, the stock is in the F&O ban, so no new positions can be created. But with that, it's a wrap on this edition of Trading Hour. We leave the markets at the lowest point of the day. Halftime report comes up next from Sonal, me, and the team that put this show together. Thank you so much for watching.